I am your host, Asa Kane. In this episode, we're going to take an in-depth look at the second bank to collapse in less than the last 2 weeks. That bank is SVB. Before we do so, if you're here watching because you want to learn about, you want to understand, and you want to make money in crypto, hit the like button right now. And I promise you that you will be able to accomplish all three. This first article that I'm going to share with you is actually from marketsinsider.com. It was published today, Tuesday, March the 14th, and it states SVB, what the worst bank failure since 2008 means for the markets, the financial sector, and interest rates. That's saying a lot. Since 2008, the worst failure. Okay. Now, all eyes are on the U.S. financial sector as shock waves from SVB's implosion hit the banking system. The bank's collapse has raised questions about a 2008 style crisis and how the Fed will respond. Here's what SVB's sudden demise means for markets, the U.S. banking sector, and interest rates. Okay, let's go in further. The stunning collapse of Silicon Valley Bank has sent shock waves across the whole U.S. financial system. The go-to lender for startups was shut down this last Friday, by regulators and put under the control of the FDIC, marking the biggest bank failure since 2008 that capped a turbulent week that saw a botched fundraising attempt by SVB and a $1.8 billion loss on its bond holdings, which ultimately triggered an old-fashioned bank run. Okay, this is what we were experiencing over the weekend. Now, SVB's meltdown was quickly followed by the implosion of New York-based Signature Bank and a crash in the share prices of regional U.S. lenders, including First Republic and Western Alliance. Stock market volatility surged while bond yields plunged on expectations the Federal Reserve will halt its interest rate increases in view of the risk to financial stability, as ripple effects from SVB's collapse spread across the world of finance. Investors are frantically searching for answers to what it all means. That's why we're here, isn't it? Here's everything that we know about these critical questions as of right now. How will SVB's collapse affect the banking sector? Silicon Valley Bank's collapse exposed a serious risk many banks face in their business portfolios: the dependence on uninsured deposits. Thanks to the tech boom over recent years, SVB's deposits ballooned. A bank might normally use such funds for lending. Now, this is important, pay attention. But SVB decided to park the cash in long-dated bonds. That proved a bad bet, as a surge in interest rates over the last year saw the holdings plunge in value. Now, analysts are worried, and not the only bank that's sitting on billions of dollars of bond losses. William Isaac, the former chairman of the FDIC, has warned of the risk of a potential financial crisis. Now, such fears have fueled a tumble in the share of prices of, again, First Republic, Western Alliance, and PacWest. These are huge banks. Customers have a lot of money in them. They're not just anyone can go in there and open a $100 account. They're not like that. However, former Treasury Chief Larry Summers took a less pessimistic view, saying SVB's collapse was unlikely to be a broadly systematic problem. Meanwhile, the CEO of Capra Bank has said SVB's failure, pay attention, could actually boost Americans' confidence in the financial system. Think about this. Think about this. Think about this. Does this raise the risk of another financial crisis? Their downfall is a big deal, no doubt. The size of its failure has only been exceeded once in American history by Washington Mutual when it collapsed in 2008. But as bad as it is, it's unlikely to trigger a repeat of the 2008 global financial crisis. Now, the second article I'm going to share with you is from MSN.com, and it was published today as well, this morning. And it states the Silicon Valley Bank debacle suddenly changed the outlook for interest rates this year. Okay, and it's only March. Investors expected the Fed to raise rates March 21st through the 22nd. That's in a week. The question was how much. SVB crashed, so now investors are betting the Fed will slow its roll. The Fed has to cool inflation without further disrupting the financial system. The weekend threw banks and financial markets into chaos and made the Federal Reserve's job a whole lot harder. In a chaotic series of events last week, regulators shut down Silicon Valley Bank on Friday. They also announced they would be bailing out SVB depositors 2 days later. The move was controversial, meeting criticism both from Democratic and Republican lawmakers. They agreed on this, at least. It also shook up expectations for the Federal Reserve's next move to curb the country's inflation problem. The Fed has increased interest rates 8 times over the last year. Pay attention, to keep prices from rising too quickly, and since December, it has slowed the pace of hikes. Let's go down. The pace and duration of those interest rate hikes is at the top of mind for markets and investors. That's very true. Last Friday, investors thought there was a 0% chance the Fed would keep rates where they targeted them at 450 to 475 basic points in February, according to the CME Fed Watch tool, whose predictions are based on investors hedging against upcoming rate hikes. Now, before SVB's collapse, investors were betting there were nearly a 60% possibility the Fed would raise rates another 25 basis points and 40% chance they would bring them up 50 points at the next Federal Open Market Committee meeting scheduled for March 21st through 22nd. Again, though inflation cooled in February with the latest CPI showing 6% inflation compared to this time last year, it's still higher than the 2% desired, so investors expected the Fed to raise rates. The collapse of SVB on Friday reversed predictions of such a hawkish Fed after vacillating much on Monday. Investors had seemed to settle their bets. Yes, okay. Now, think about all of these interest rate hikes. This is a domino effect. Everything is a cause and effect. All right. Now look here. Investors expect the Fed to back off its aggressive rate hikes because these indirectly caused SVB's collapse. The Fed rate hikes made borrowing more expensive, killing the bank's primary business from venture capitalists investing in tech startups, forcing their sell-off of government bonds at a loss of $1.8 billion, and leading depositors to make a run on the bank when they feared their money was no longer safe. Okay, this is what has happened. Meanwhile, Goldman Sachs thinks the Fed won't raise rates as more banks are already expected to fail. Okay, another joke could put banks in the red zone. All right, you need to be thinking about this. The Fed will announce its next interest rate decision next week, and it's likely Jerome Powell, the chairman, will be asked to address their fallout during a press conference. Now, Elizabeth Warren, who on Tuesday called for him to recuse himself from the Fed's internal review of SVB because she said his actions to allow big banks like Silicon Valley to boost their profits by loading up on risk directly contributed to these bank failures. Okay, so now we're looking for someone to blame. Now, whether they are the right person or not, we will see. Okay, but we need to find out. Now, this is their actual website right here that we're looking at, and I just wanted to share this with you. And as you can see here, it says Silicon Valley Bridge Bank is a newly created full-service operated bridge bank. It's open for business and new and existing depositors have full access to their money. I think it's safe to assume that most people will be pulling their money out as soon as possible today and in the coming days. I'm sure not everyone will. I mean, look at, there are failed projects like Luna that still have millions and millions of dollars invested in them. I mean, so as you can see here, some of their partners right here down at the bottom. I just wanted to share this with you all. Okay. Now we can see here, I wanted to also share the market as of today, Tuesday, March the 14th. The market has bounced back tremendously over the last 48 hours, okay, from Friday just falling off a cliff. Look at Bitcoin. Not only has it rebounded from what it was Thursday and Wednesday, it has surpassed that now at over 24,000 after cooling off over the last few hours, all right? I wanted to share this with you. This is important because how Bitcoin and Ethereum go is how the rest of the market goes, all right? I mean, that's just how it goes. They are the gold standard. We can see here it's low over the last week, down to 19,000, which, I mean, that sell-off was tremendous and it was very rapid. And then Ethereum, we can see here close to 17, 16, 8. And XRP, Matic, Dogecoin, they have all rebounded over the last couple of days. All right, and if you had any kind of disposable income, hopefully you were able to buy some of the coins you're in at the dip, I should say. All right, now in addition to that, if you have not already, you can use our links to Coinbase and Crypto.com. You can use them and get $65 in crypto. Also, protect what you already have, because if you don't, you may not keep it. Now, having your own cold storage wallet is really the only way to do so. Ledger is one of the leading worldwide manufacturers of crypto cold storage wallets. We're looking at their Ledger Nano S right here. You take it off the whatever exchange you have it on, whether it's Coinbase or KuCoin or Crypto.com, you put it on your Ledger. Okay, and that way no one else can steal it from you. You can also manage over 5,500 digital assets. And now you can even manage your NFTs on it. You got a Bored Ape, put it on here. And then no one can steal it from you. Okay? Now, if this video has been of value to you, and if our channel has been of value to you, contribute back by sending the super thanks. It is greatly appreciated, and also it goes into helping our channel grow and provide all of you with even more value. You can also send any ERC20 token to our address. Next video coming out tomorrow. Until next time, get in there and make it happen.